Carolina. And moderating today is Steve Daniels, anchor and reporter at ABC 11 WTVD.
I love this session because this is where we give you a roadmap for the year ahead. We're going to dive into some serious points here. We've heard a lot of optimism. We're going to reflect that optimism and the realities of what all of you are dealing with every day where you are. And this is always, I find, a really valuable session where we get together, we talk it out, and we really do live what this is. This event is the forecast for the year ahead in many respects and what we'll encounter. Let's dive right in, and as we get this roadmap in hand and talk about first the economic outlook for North Carolina for the year ahead. My good friend Gene Flood is back with us again this year. Gene, we lean on Gene all the time on ABC 11 for his perspective on television when it comes to all things economy. Brad Jones from First National Bank and Mitch Perry from Blue Cross Blue Shield. So we're excited to get right in it here and give all of you some practical guidance for the year ahead. So Gene, let's talk first kind of high level, where you sit, the global perspective on where the global economy is and how the American economy is looking against that backdrop of what's happening globally right now.
Okay, thanks very much, Steve. And Happy New Year to everybody. Good to see you again. As Steve knows, I'm from Massachusetts, so I really want to talk about the Patriots. How about those Pats? But okay, we'll come back to that. So what I'm going to do here in this first part of the session is really set the stage and talk at a high level about where the global economy is going. And then we'll drill down to the United States and then to the States. As I look broadly out to the next couple of years, so 2025, 2026, and 27, what I see is a continuation of trends that have been in place for the last decade or so. And so I want to talk about three things. I want to talk about growth, number one, number two, inflation, and then number three, interest rates, because I think each one of those are really important for us to understand the stage that we're working with. So first of all, growth. What's happened with global growth over the last 10 years is we've moved from roughly 4.5% growth on an annual basis down to the low threes. And so looking ahead in 2026 and 27, what I see is global growth running at about 3.1% next year, 3.3% the year after. So that's the broad trend there. Number two, I'm going to talk about inflation and what's happened with inflation, and President Barkin talked about this a bit, is over the last decade, inflation has been moving down gradually on a global basis. Obviously, we hit the lows right before COVID. We had the spike came up, and then inflation's been coming back down and settling. But it's been settling at a rate that is higher than the rate that was pre-COVID. So that's number two. And then number three, with interest rates broadly also follow inflation. And so we have seen globally interest rates have moved down for the last 10 years and then spiked up as the central banks globally started to fight the inflation. And then they've started to settle again. But just like inflation, they're at a rate that's higher than pre-COVID. So those are the broad trends that we're seeing. Now, even though we're in a picture that looks, and when you just look at those headline numbers, not that dissimilar from where we've been, looking forward, the landscape, in my view, has changed. And so there's really three things that I think really differentiate what we're going to see over these next couple of years from where we've been. Number one is that the economies are much more fragmented than they were coming in. And so we are in what many people refer to as a multipolar world. And so what we've got is, what's happening is kind of globalization in reverse. That's kind of factor number one. Factor number two is technology is going to play a much more important role in geopolitically driven transitions within the economy are going to also be important. That's point number 2. And then point number 3 is the cost of capital is different going forward, is going to be different going forward, I believe, than it has been in the past. And in particular, it's going to be higher, and that's going to be important for decision making. So let me just spend a minute or two on each one of these factors. So on growth, first of all, you've heard in the past that we've had this conversation, right? There are a group of high growth countries in these large economies, and over these last 10 years, they've been pretty consistent. So India's been number 1, and then China number 2. Going forward, I've got India running at about 6.5%, China at about 4.5%. That's the top group of the big economies. The bottom group in the big economies are the Eurozone, the UK, and Japan. And roughly speaking, they are going to be running at about 1% growth over these next couple of years. The US is in between. Now, why is the US sitting at this place that is above many of the other developed economies? I think the key reasons are for these next couple of years, more accommodative monetary policy, and then also more fiscal stimulus than the other groups. And then also, the other thing that I think is going to be important is that for the US and then also to China to an important extent, technology and then this transition is important. And you heard Tom talk about it, also heard Tim talk about it, this build out of new technology and the infrastructure associated with vastly increased need for electricity. So those are key issues that will be driving growth. And I think for the US, where we're going to see growth come in is right around 2% for these next couple of years. So positive as my base case. For inflation, and I'll do this one more briefly, as I told you, it's come down. Then we had this spike with COVID, and then it started to settle back in. I see inflation, core PCE, the personal consumption expenditure in the US, running at just above where we are now. Tom talked about it, 2.8. I've got for 2026, 2.9. That is in part due to tariffs. And then for 2027, coming back down to 2.3%. Now, what's caused this spike and what's keeping it up? First part is that we have this impact from tariffs. And so tariffs have moved from roughly 3% for the United States to 15%. That caused a spike as prices jumped up. That's transitory, though, because prices won't jump up again because of tariffs. And so as it feeds through the economy, it's probably kicking in maybe 0.5% to a little bit more on inflation for this first part of this year. But then as we go beyond that, the tariff impact will be much less. Now, more importantly, though, after this transition happens, we've got structural component, which is going to be important because supply chains that have to get rebuilt need to be reformed. And so efficiency is no longer the key driver as it was during globalization. And people really want risk management now, and they're willing to pay more for that. That's going to take time, and so we'll have a structural component to inflation that's going to be somewhat longer lasting. And then the last thing that I would want to mention here is, as I mentioned before, is the easier money in the U.S. And easier money tends to lead to a little bit higher inflation. So I've got inflation high, still above the Fed's target. And the last thing is on interest rates. Interest rates, as I said, have been following largely inflation. Going forward, policy rates for the Federal Reserve Board at 3.125%, or call it 3% to 3.5% over these next couple of years. And the reason that they're not coming down further, as we had them pre-COVID, is that We've got this structural inflation that I mentioned just beforehand. Also, fiscal deficits are important. So fiscal deficits historically have been kind of 2.5% to 4% for the U.S. They jumped up to 10 or 12% appropriately during COVID. Now they're back down to about 6%, but they're not all the way back down to where they were. That puts upward pressure on interest rates. And then also there's strong demand for corporate borrowing, and that keeps the spread of corporate rates above treasuries by a larger margin. So those are really the key things. So in review, just to set the stage, we've got global growth that'll be about 3%, that's drifted down slightly. Got inflation. Inflation call for the U.S. is high 2s for next year, mid 2s for the following year. And then policy rates that have also started to come back down, but not back to their lows. So that's kind of the global backdrop for the economy.
Brad, let's talk to you about, from a banking and lending perspective, what you're seeing in terms of what is guiding businesses right now in their business with your bank and with others, and when it comes to lending and capital. What are you seeing?
And so I'll talk a little bit about what I view as kind of the predictive factors that will make the biggest impact in terms of their willingness to make decisions. And if you think about what we do as bankers, I love the job because you're out there every day, you're meeting with business owners, and you're being part of those decisions that help them decide whether or not they want to move forward. Well, the first priority that I would say that is on everyone's mind, and it's somewhat obvious, is the interest rates. But I would say these interest rates really have two facets to it. On the short term, there's some real benefit to that. It can improve profitability, but it generally funds a lot more of your working capital. And there's absolute benefit to that, as well as for some of the larger organizations that are able to float and not as concerned about being fixed rate, they get the benefit associated with it. But I would say the second facet, which is probably even more important, is what happens out on the yield curve as you go out kind of 5, 7, 10 years, where you have your more permanent financing that's going to impact major expansions and M&A financing and other elements that probably do as much to drive. And so we're continuing to watch that, and while you certainly have had reduction in the short-term rates, and there has been some out on the long term, it just hasn't been at the same level. And so we'll continue to watch that, and as we see that move, that will impact the confidence. The second thing that business owners are wanting to talk about is the labor force. And it's interesting. I like to use the Goldilocks analogy. You don't want it too hot. You don't want it too cold. You kind of want it just right. And so that's where we've been fortunate as a state. I mean, we have such good community colleges, such good public universities that help provide us with a workforce that has just been, that makes it incredible for us. But it is a challenge. And the thing that I would say about that labor force is it's not as important to most business owners what's going on a national level or either state level. They want to know what's going on in their market. If I'm looking to make a plant expansion, if I'm looking to do, another operating line, am I going to be able to have the workers to do it? And so that's where having that relationship with your bankers, your accountants, your lawyers, to really know what's happening in your market and have that dialogue, I feel like is really so important. And then the third point, and this is really 2B, is just what's going on with in-state migration. Hey, it's been awesome. When you see what's going on here with the number of people coming, it's a major boom to us, and that's something we need to do as a state, not take it for granted. I think population in the last 25 years, 24 of those years have been positive population for North Carolina, and that's a big part of it. And I'm from Charlotte. And the last stats I saw was we got 157 people coming every day to the city, which is just amazing. Well, that's 157 people that need a place to live. They like to eat out, and a lot of them, need to work. And so there's a lot of benefit that comes from that. And so the final point I'll make, and Steve, this is probably a little bit different for you being an anchor on the news, but you like spicy and exciting headlines. And I would say most of our business leaders, they like it being somewhat boring. They like kind of steady state, nothing particularly happening, just, as you get the more boring headlines and less things happening, they get more comfortable and their crystal ball gets a little bit clearer and they're a little bit faster to go ahead and pull the trigger on some things.
I will say that there is, from where I sit and reflecting what's happening in our communities across our viewing area, there is so much optimism about where we're going as a state, about where we're going as a region. So our spicy headlines are about the excitement of where North Carolina is headed. So I'll just share that perspective. I want to talk now about the intersection between consumer behavior and business decision making. How all of you who are running businesses in this room are making your decisions based on consumer spending, consumer behavior. So as we forecast ahead, Brad, let's continue with you and what you're seeing in terms of business spending and borrowing, your conversations with businesses as they're looking at the consumer horizon in front of them.
Yeah, what I would say is we're seeing a rational and disciplined borrower out in the market. They're being somewhat selective. They're wanting to make sure that they're investing in productivity, technology, and mission-critical capital expenditures. So the spending is occurring, but I would say it's being a little bit more selective. And I think of it in terms of every capital investment, it has a rate of return that you're looking to hit. And I would say right now, it's probably a little bit higher right now than what it was a few years ago, but we're still seeing some benefit from it. And, we've seen some real benefit that came in from some of the tax accelerated depreciation with the tax laws on the leasing. So we got a nice really pickup there. And what I'm most encouraged about is if you look out across our borrowers, I would say in my 37 years of doing this, our borrowers across the industry have some of the strongest balance sheets they've ever had. You're seeing debt has been reduced. We're seeing significant liquidity that's being increased, and that's just giving them opportunities for what's coming down the pike. Because I would also say things are changing faster now than they ever have in my career as well. So trying to make sure you're positioned for whatever comes down the pike at you, and I feel good about where our borrowers are. And one of those things that is definitely coming down is, and this started really in the second half of last year, is M&A started to really pick up. And we see that continuing. I've read kind of reports from most of your major investment banks, and we think that M&A activity is going to continue strong into 26. And I think Deloitte just put out a really nice survey where I think 90% of the PE firms and 80% of the corporations are expecting M&A to increase. So that's going to really help from a borrowing perspective and keep things fueled. So what I would say is, our customers, they're not making decisions based on fear, but they're making decisions based on maturity and diligence. And a big difference is when you come in as a banker and you're meeting with these clients, they now want you to be part of making strategic decisions about their capital, not just being a source for it.
Gene, let's go to you and these broader trends when we're talking about things like consumer trends and capital trends, which our bankers in the room are very familiar with. How do those reflect to you, and when we look at things like inflation and employment and productivity? What are you seeing and what's reflective there that you're seeing?
So, Steve, on a national level, what we're seeing is that for the consumer move is in line with this slow trend down that we've seen for the economy overall. So there's really three factors that drive the consumer behavior on a national level. First is unemployment. The second, right now, is taxes. And then the third thing is tariffs. Now, with the employment trends, what you can clearly see in the data is that if you look at a statistic like the monthly change in non-farm payroll, right? That has moved down from an area that is, you see in robust times, it's a number like 150,000 to 250,000. We are now at a point where the most recent numbers for change in non-farm payroll are about 50,000, right? So it's only a fraction of what it is during the healthy times. And that is one of the biggest drivers for consumers. So over these next couple of years, I would expect to see non-farm payroll on a monthly basis average something like 75,000 or so. That's the first thing. So there's going to be a slowing just because of job growth. Second thing is taxes. Now we have this big, beautiful tax bill. So how important is that and how long does it last? It probably adds something on the order of 0.5 percentage point to 0.75 percentage point over a few quarters. But then it dissipates and then that's gone. So we have a hump that comes from there. That's working against the change in job creation. And then the final thing is tariffs, and I mentioned this earlier, is that we have this tariff that are adding about 0.5% to inflation, but the way you can think about it from a consumption perspective is that it's cut consumption by about 0.5%. So the size of the impact, the negative impact of tariffs is almost as big as the positive impact to the big, beautiful bill. So those things are kind of offsetting each other. Now, there's other things that you want to keep in mind, but these are going to be much smaller. So I would say, for sure, you want to keep in mind financial conditions are easing, and as Brad mentioned, that'll impact behavior some. We think that impact is going to be relatively small, maybe 0.25%. The immigration effect that Tom mentioned, so less immigration, the economy is growing slower as a result, that impacts consumption. And then the final thing that I mentioned is AI, and we've each touched on that some, but let me tell you about how I think about it. There is the building that Tom talked about, so there's the actual infrastructure, new buildings, et cetera, that are being put up. That causes a bump up. But most of the cost of the AI build out, 70%, fully 70%, is from imported goods. And so most of that benefit that we see in all this big activity is benefiting other economies directly in the spend. And very little of that actually gets spent in the United States. The second thing is we talked about productivity enhancements, and we're all hoping that those will come. But those are somewhat slow to come. And so in 2026 and 2027, I'm expecting to see that while we get a little bump from that, it's not going to be large yet. But one of the things that we will see is hiring that doesn't take place or even job losses. And so that's going to be working in the other direction. So the impact on the economy of AI in the next couple of years is going to be, I believe, relatively modest. And we're hopeful that as we go out into the future, we're going to see much more. So with the consumer, employment's the big story. That's slowing. And the second thing that I would take into account is that we've mentioned a couple of times, this recovery is K-shaped. And so it not only impacts lower income and middle income consumers less, it also impacts only a few sectors, at least right away. It's primarily technology and finance.
I want to dive in now to the cost of healthcare, which affects so many of you running your businesses. And Mitch Perry's been patient here. Mitch, thank you.
No worries. I've enjoyed listening to Dr. Flood and Brad.
Mitch is here to really shed light on healthcare in so many respects, as a line item for you, those of you running businesses, as how you maintain competitiveness, how you're attracting employees, and also how you're managing that expense as it continues to grow. Mitch is the CFO at Blue Cross Blue Shield, and so we really want to dive in here. There is concern that the cost of healthcare here in North Carolina is higher than other states, and that is really a detriment to those of you who are running businesses and working to expand and all of that. First, why is healthcare more expensive here in North Carolina, and what's your view of it? Where is this going?
Well, maybe if I could start with the positives, of course, about who we are as a state. I'm a lifelong North Carolinian. I think we have many advantages. I think we live in the best state in the nation. Sometimes I wonder why everyone doesn't live here. And Jim, based on Jim's statistics, I guess everyone will here at some point. We have tremendous healthcare centers, healthcare system, academic health systems. Brad mentioned our community college systems that I think are making a big difference in how we're addressing rural healthcare gaps. And there's so much innovation here. I work with companies across the nation that want to work with us in North Carolina because of the health systems and the innovation that we have, and really how our state continues to reshape. You really laid it out, I think, Steve. The issue we have is one more of economics. It's the challenge, I think, for our generation is the affordability of healthcare. I know we've spoken about affordability quite a bit. Some of you have probably heard the statistic. The average family of four can expect to pay about $30,000 for healthcare a year. Healthcare is paid in a number of different ways, of course, through the ACA, through government programs, of course, Medicaid, Medicare, and others. We also have employer-sponsored healthcare coverage, which most of you, I'm sure, offer. About half of North Carolinians get their healthcare coverage that way. But no matter who pays, $30,000 out of roughly, $85,000 average income is a significant burden. And it's more than that. It's the growth in healthcare, of course, that is driving a big part of the issue. We talked about core inflation. What was it, Dr. Flood, about 2.8? Inflation in healthcare has spiked to over 8%, which is about 3% the cost of other goods and services. So it's a significant issue. I would be remiss if I didn't at least speak about the uncertainty that we're seeing and the potential instability because of the potential expiring subsidies at the ACA level. Our estimates are that about 250,000 fewer of our neighbors across North Carolina will get coverage through the ACA because of the expiring subsidies. That's about 30% of that marketplace, which not only creates instability in that system itself, you have a smaller, sicker pool, but I'm concerned about the uncompensated care that potentially comes across the entire healthcare system. You know, one thing I would say before I maybe move here quickly to what are some of the drivers, our advantages far outweigh our risk. There's a lot of great work that's going on across the healthcare system, and there's a lot of innovation coming into the healthcare system that's making a difference. It needs to make a faster difference, and that really is the opportunity and the challenge of not only our company, but of our state. Well, one thing I was going to do is just to talk briefly, really quickly, about the cost drivers, because I get asked often, why is healthcare so darn expensive? And to be clear, it's not just a North Carolina issue. This is a national issue. But we're a microcosm to some extent of what's happening across the country. Healthcare is largely delivered locally, so of course the costs are going to be borne locally. Some of the challenges are longstanding. There's a lot of work that's been going on across my career and even before my career to address them. Things that I'm sure you understand. It's a system built on sick care or treatment over prevention. There are a lack of transparency and ability to shop in many cases. Access issues, especially in our rural areas where we have one of the largest populations in the nation. Really great work going on there. It needs to be faster. It needs to be more effective. Unfortunately, what we've seen here over the past, I'd say, handful of years, really coming out of the pandemic, are some factors that are really impacting cost even more significantly. And in the interest of time, I'll try to be brief. The factors that I would point to, far and away the biggest, are chronic health conditions. About 2/3 of North Carolinians have at least, are living with at least one chronic health condition. Think of heart disease, think of diabetes, think of anxiety. And the truth is, those are expensive to treat. It costs North Carolina about $65 billion a year. And I would add to that list behavioral health, which unfortunately has become the legacy of the pandemic. Doubling growth, it wasn't in our top 10 spend pre-pandemic. It's now one of our top 5 spend, doubling growth. And it's actually more significant than that because 2/3 of individuals that have a behavioral health claim have an underlying medical condition. The second factor I would point to is really positive at the end of the day. It's the aging of our population. We have a great state that's very attractive to retirees and individuals over 65. I'm pleased to announce I've been able to convince my mom to move back to North Carolina after a number of years in South Carolina. The reality is that brings with it higher cost, and largely because of chronic conditions, the average individual over the age of 65 cost about twice an individual under the age of 65 their annual health care cost. And then the final issue that I would point to is really more, I'd say it's still very positive, but it's the cost of innovation. We're living in a time, we're living in a state, in a country, fortunately, that has seen tremendous medical and pharmaceutical innovation. It's improving quality of life for so many, saving lives. And there's no way that you could ever put a value on quality of life, of course. And I do believe firmly that over time, these treatments will lower the cost of healthcare. In the near term, though, they're increasing the cost. They're growing at over 10% per year, and their share of the healthcare dollar continues to grow. About 10 percentage points since the time I took over as CFO at Blue Cross has pharmaceuticals increased as its share of the healthcare dollar. So many challenges, many opportunities, I think, that great work, and it really is, I think, the opportunity not only of our state but of our country to make certain that we're coming up for solutions and working together to make certain we have a sustainable system.
And I'm glad you mentioned chronic disease too, because I think that's certainly something Blue Cross Blue Shield really pushes to minimize chronic disease, help people get chronic disease under control, and I think that's something everyone in this room can help in their organizations as well. The importance of that, spending money there to potentially reduce the overall healthcare costs if you're managing these chronic conditions on the front end or preventing them. Gene, let's talk to you about, from your perspective as an economist, the role of rising healthcare costs and the impact on so many other issues like labor force participation, wage pressure, the things that so many people in this room feel as they're running their organizations.
Healthcare, in many ways, and at least in my mind, in the United States, we look a lot like education, and I spend a lot of time on education. I spend a lot of my time now on global health issues. And what the blessing that we have here in the United States in healthcare, in the same way we do in higher education, is that our top programs and our top institutions in this country are many of the best in the world. And so people come here from all over the world for treatment at that high level. And we can do we do an excellent job on that. The real difficulty, the place where we struggle though, is for kind of the masses of the population who have problems with both access and with cost. And as Mitch described, with healthcare inflation running at about 8% or so, with overall inflation running at about 2 to 3, it's going up faster by multiples than the rest of the affordability issues. And so this one is one that is high on people's list, and it's what many people are complaining when people say affordability. They're saying, how am I possibly going to deal with these healthcare costs? How am I going to deal with these educational costs, et cetera? So it's in that very tough circle, unfortunately, for a lot of the U.S. population. Not for the highest, but for most working people.
Yes, Steve, there was a recent Gallup poll that said 30% of Americans say their top concern is the cost of health care. As I said, we're fortunate. Thank you for many of you who are employer customers. We have many employer customers, and they speak very directly to us that their biggest concern is cost and how do you help us come up with solutions to address chronic health conditions. So definitely it is top of mind for many people.
So Mitch, just building on that, what can the people who are in this room, who are our employers, running organizations, what's your advice to them? What can they do to help manage the cost of healthcare in their organization?
Yeah, no, it's a really good question. And I appreciate the fact that I've laid out all the challenges. You give me a chance to be a little optimistic and give some solutions as well. And as a CFO, I understand these issues. There's the strategic imperative of healthcare cost and the importance of being able to attract and retain talent. We have a lot of diversity across our state. I know we were just discussing the different sizes of banks. We have member groups that are from one member all the way up to over 60,000, and everything in between. So a lot of different size, different makeup of workforce, different ability to absorb cost volatility, of course. So fortunately, there's a lot of innovation and solutions that are coming to market. They've been in market, coming to market even more quickly, that I think support that diversity. And maybe really quickly, I would just speak in two quick categories. One is more program design at the employer level, and then one, of course, is the healthcare cost management. At the program design, we are seeing a move. We've seen a move for a while, but it's really accelerating over the past couple of years from what I would call more fully insured, one-size-fits-all opportunities to more customizable things that can fit for each specific employer. Self-funded, of course, for large group employers has long been there. But recently, we've seen acceleration in more hybrid structures that have a self-funded option or self-paid option, but also has a catastrophic layer that allow to make certain that there aren't costs that get too high, so it becomes too much of a burden. Those are picking up steam for smaller employers. We're seeing third-party administrators that have long been in the market, but they really are becoming more popular because they offer a lot of flexibility in benefit design and network design. And we're seeing group purchasing options. And one of the one that we have that we just did it and introduced this year in partnership with the North Carolina Chambers, Carolina HealthWorks, and that creates a great opportunity and flexibility for employers to look at different payment options. The other thing, though, is ultimately how you pay is not the main issue. As Gene was saying, is how you control the cost of chronic health conditions and other costs. And so I would put the other items into the cost category. A lot of innovation there, and a lot of products. Obviously, if chronic health conditions are the biggest cost, you've got to have a structured program to prevent and manage those costs. I think it's also important to help your employees get cost at the most effective location, at the most effective cost. Primary care, urgent care are very important. Telemedicine options, but also virtual care options beyond just basic telemedicine for specialties in primary care are also important. And then there's innovation that just recently, over the past couple of years, has come to market, and I actually think it will pick up a lot of steam. And that are opportunities for employees to be able to shop more transparently. Basically pairs technology and allows them to understand what shopping options they have. It has lower fixed cost, often with a copay, so that they can see what they're buying before they go for that service. A lot of opportunities, a lot of way to think about it. We think about it as right care at the right place at the right time. The way that I would say it is, it's important to engage at the employer level and see what options might make the most sense for you, and also to encourage your employees to engage in their health care.
I will tell you, in this environment right now, I think it's somewhat basic, but it is so critical that as business leaders, that you stay close to your customers. They are changing rapidly. So you want to stay close to your customers, you want to stay close to your people, and you want to stay liquid. And so as you think about your customers, there's a lot of change coming down the pike. They're going to be evolving. You want to be there with them at the table. So as they evolve, you're an important part of that evolution so that they're not having those conversations with other people. And then as it comes to your people, we've talked about the labor challenges and the skilled labor, despite the strength of what we have with our college systems and the people coming here. Having that relationship with your people that is collaborative is absolutely critical. That helps them from a retention perspective. But I will tell you, as somebody that's been doing this for 37 years, and I'm fortunate enough, I have a lot of our core associates and young bankers, they sit outside my office. I learn a lot more from them than I'm able to teach. I go out there and they show me all these things with the software, and they're teaching me how to use AI. And so having that discussion with your employees on a daily basis can make an enormous difference. And then the last point I would make, and this is somewhat tactical, but it's really practical as well. You want to make sure that your financial reporting is pristine. There's a lot of change, there's things coming down. You want to be able to capitalize on that. So it could be from the perspective of, hey, you need to raise more capital than you ever anticipated. Well, you got to make sure you've got the reporting that's going to get you access to that level of capital. That could be different than what it's been in the past. And so I would also tell you that we've seen several mergers and acquisitions that ended up falling apart because the target just didn't have the level of financial sophistication that they wanted to be able to move forward from the buyer's perspective. And so, you know, when you're looking at that, your kind of financial reporting, when you really need it to be good, it's too late. You need to be way out in front of it. So I would not hesitate. Be ready so that you can capitalize on the change that's coming your way.
Gene, what is, from your view as an economist, what is the biggest wild card you see out there in the landscape right now that we should all be keeping a focus on?
Okay, Steve, I think this is really important at this time. Builds on what Brad was talking about. But as many of you know, I'm on the board of directors of Janus Henderson Group, so it's about $500 billion organization. I chair risk globally. So we're looking at risks across the globe on all different parts. One of the things for me that worries me the most, it looks different than risks that I have seen through my career. So go back to '87 crash, and then emerging markets, and then the tech wreck in 2000, 2008. The risk that concerns me the most right now is geopolitical. And the ways that shows up, very different than the kinds of things that we had, where we had the mortgage crisis, so forth. Where this is something, and I'll give you an example, is Venezuela. Right? So if you think about that, sure, it's possible that we just sail through that and it's relatively benign. But we could also get on a branch of outcomes that looks pretty terrifying, so that we could have prolonged instability, potentially political unrest. Oil could spike, tighter financial conditions, especially related to Latin America, emerging market spreads widening out, investors pulling back, banks having a lower appetite for risk. All of these things, continued sanctions, more tariffs, could come with, if that situation deteriorates. And what that's going to translate into on all of those scales is slower growth and worse performance in financial markets. So the thing that I think of as the kind of most worrisome of the major risks that are out there are geopolitical risks at this point.
And we're seeing the confluence of that every day right now. So it is something to keep an eye on. We are at the end of our time, and I want to thank everyone. Brad, Gene, Mitch, thank you very much for your perspective. It was extraordinarily valuable. We hope it has given you a roadmap for the year ahead. And again, great to see all of you again this year.